Bitcoin just crashed. Again. Prices dropped fast. Billions wiped out. Liquidations everywhere. And if you've been in crypto for more than one cycle, you've seen this movie before. But here's the problem. This time feels different. Not because of one exchange blowing up, not because of some hacker stealing funds, and not because of one bad headline. This drop is happening for a deeper reason most people still don't understand. And if you miss what's really going on, you won't be ready for what comes next. So in this video, we're breaking down why Bitcoin is falling right now, what big money is quietly doing, the hidden forces moving crypto, and where Bitcoin could go next. Stay with me, because the last section might change how you see this entire market. Let's start simple. Bitcoin didn't just fall on its own. It's reacting to the global financial system. Right now, markets are in what traders call a risk-off mood. That means investors are pulling money out of risky assets. And crypto sits at the top of that risk list. Why? Two big reasons: high interest rates, tight liquidity. When interest rates go up, safe investments like bonds start paying more. So big funds ask themselves, why risk volatility in crypto when we can earn steady yield elsewhere? So money rotates out. And when liquidity tightens, meaning less cash flows through markets, speculative assets get hit first. That includes tech stocks, growth companies, and yes, crypto. So this isn't just a Bitcoin story, it's a macro story. Now here's where things accelerate. Crypto runs heavily on leverage. That means traders borrow money to trade bigger positions. When prices rise, leverage makes gains explode. But when prices fall, it turns into a chain reaction. Here's how it works. Price drops slightly. Leverage traders get liquidated, exchanges force sell their positions. That selling pushes price lower, more liquidations trigger. It's a cascade. And because crypto markets are thinner than stock markets, moves become more violent. A $5,000 Bitcoin swing in minutes? Not unusual. So part of this crash isn't fear alone. It's mechanical selling. Now we get to the psychological layer. For years, Bitcoin had a clear narrative. It was pitched as digital gold, inflation hedge, future money, payment rails, financial freedom tech. But today, investors are asking, which one is it? Really? Because the last few years created confusion. During inflation spikes, Bitcoin didn't always rise. During banking stress, it didn't always act like gold. And payments adoption? Still slow globally. So the market is reassessing the story. And when a narrative weakens, prices often drift until a new one forms. Here's one rule that drives all markets. Assets don't move on logic alone. They move on liquidity. When central banks print money, asset prices rise. When they drain liquidity, assets struggle. Right now, global liquidity isn't expanding fast. Money supply growth is modest compared to pandemic years. So stores of value like Bitcoin don't get the same tailwind they once had. Think about it this way. Bitcoin doesn't rise in isolation. It rises when the currency it's priced in loses purchasing power faster. If dollars, euros, or yen weaken quickly, Bitcoin often climbs. If liquidity stays tight, price growth slows. Now let's talk cycles, because whether people like it or not, crypto still moves in cycles. Historically, Bitcoin follows a 4-year rhythm tied to halving events. Supply issuance gets cut in half. That supply shock drives attention, then speculation, then mania, then correction. We saw peaks around 2017, 2021, and most recently, 2025 after peaks. Comes the cooling phase, often lasting about a year. So if history rhymes, not repeats but rhymes, we're inside that cooling window now. That's why some analysts call this period crypto winter. Not permanent, but emotionally heavy. To understand price, you need to understand participants. There are 4 main groups in crypto. 1, investors. They buy when price is below fair value. Long-term thinkers. They don't panic easily. 2, traders. They chase momentum. Up or down, they just want movement. 3, hedgers miners fall here. If Bitcoin trades above mining cost, they sell to pay bills. 4. Gamblers leverage users. They create parabolic rallies and brutal crashes. Right now, gamblers are getting flushed out. Leverage is unwinding, and markets are resetting toward investor territory. That process takes time. Here's something many retail traders miss. Bitcoin price isn't set only by spot buying. Futures markets dominate volume, and futures allow traders to sell Bitcoin they don't even own. That creates synthetic supply. It's similar to commodities like oil or gold. If institutions short futures heavily, they can suppress price momentum temporarily until demand overwhelms that pressure. When that happens, short squeezes ignite explosive rallies. We've seen it in metals, and we'll likely see it again in crypto. Now let's talk valuation. Some analysts use network growth models like Metcalfe's law. Others compare Bitcoin to gold's monetary value. Different models, similar conclusions. Bitcoin has a fair value zone. When price moves far above it, corrections follow. When price falls below it, accumulation begins. Recent estimates place fair value around the mid-five-figure range, which means current price action may be closer to equilibrium than panic suggests. Markets often swing above and below fair value before trending again. Zoom out further. Crypto doesn't exist in a vacuum. Global economic power is shifting. China is expanding trade influence. Emerging markets are gaining strength. Currency competition is rising. And when reserve currency dynamics change, alternative stores of value gain attention. That includes gold and Bitcoin. So long-term demand drivers remain intact, even if short-term volatility dominates headlines. Another layer impacting sentiment: government policy, stablecoin regulation, exchange oversight, custody rules, all shape crypto's future. Some policies support adoption, others raise fears of control. There's ongoing debate around self-custody rights, central bank digital currencies, stablecoin dominance, transaction monitoring. Whenever regulation uncertainty rises, markets hesitate. Clarity often brings confidence, even if rules are strict. Now the question everyone asks, where does Bitcoin go next? Bull arguments focus on three forces. 1. Supply halvings. New Bitcoin issuance keeps shrinking. Scarcity increases over time. 2. Institutional access ETFs and funds expand investor entry points. Even if hedged, exposure grows. 3. Currency debasement, long-term debt levels push governments toward monetary easing, which historically boost hard assets. Some long-range models project six-figure Bitcoin in future cycles. Extreme projections even higher. But those depend on liquidity expansion and adoption speed. Here's the mistake most investors make. They mix time horizons. Short-term, Bitcoin is volatile, emotional, and liquidity-driven. Long-term, it tracks adoption, scarcity, and monetary trends. So fear dominates bottoms, and euphoria dominates tops. Understanding that emotional rhythm matters more than predicting exact prices. Professional investors track signals like liquidity expansion, rate cuts, money supply growth, ETF inflows, miner selling pressure, futures positioning. When liquidity returns, crypto often moves first. It's a forward-looking market. That's why major rallies often begin while news still looks negative. So here's the reality. Bitcoin didn't crash because it failed. It dropped because liquidity tightened, leverage unwound, and narratives weakened temporarily. But cycles didn't disappear. Supply didn't change. Adoption didn't stop. And global monetary pressure didn't vanish. Markets move in waves. Right now, we're in the pullback phase, the uncomfortable phase, the phase where conviction gets tested. But historically, that's also where future opportunity forms. So the real question isn't, is Bitcoin dead? It's, are you prepared for the next phase when sentiment flips again? Because when liquidity returns, when leverage resets, when narratives rebuild, crypto doesn't move slowly. It moves violently. And the people positioned early are the ones who benefit most. If you want deeper breakdowns like this, macro, crypto, market psychology, subscribe and stay connected because the next cycle is already forming quietly.